What's up, you guys? I was recently talking to a broker that I've known for several years, and he primarily brokers FedEx routes. And I was asking him about what his opinion was and what he was seeing in terms of the lending environment for people buying FedEx routes. So in mid-2023, we're seeing right about 10 to 11% in terms of interest rates, and a lot of times these loans last for about 10 years. Now granted, different banks are going to have different terms and interest rates and so on, but this is going to be a pretty good general idea. Let me give you a very quick rule of thumb. If you have a loan and it is at 11%, 10 years, generally speaking, if you have got a business that's selling for a 3x multiple, so 3 times its net income, it will take about 50% of your net income. If you have a business that is at a 4x multiple, so 4 times the net income, it's going to take 2/3 of your net income to pay your loans. So a lot of times when people see, hey, I've only got 1/3 of that net income claim at the end of the year, this isn't worth it. And granted, for some people, it's simply not. But a lot of times I think that it can and it should be worth it. And that's what I want to talk about today. So the reality is everyone goes through this pain in their first acquisition, where they're buying this business, taking on mountains of debt, and essentially working for what seems to be peanuts. And again, that can be not only a painful thing, it can be dangerous if you don't have enough working capital and all that kind of good stuff that you have to deal with operationally. But the point is, everyone goes through it, and once you're done with it, now whenever you sell the business and buy another business that's about the same size, well, now you can pay for it with cash. Now you can get all of the net income that's currently being generated whenever it transfers over to you. There's all sorts of good stuff. But everybody goes through that. And the reality is that your loan payments aren't just going off into the ether. Like, you're getting principal pay down, and it's sort of like a forced piggy bank. Now, granted, some of that is going to vapor because you're paying 11% interest, but essentially you are still paying this thing down. And if you only look at a business and the idea of like, how much money is this going to make me, especially after you're getting a loan, the thing that will happen is the only thing that will look good is a job, because there's no debt service, everything's 100% profit, very little risk. There's no debt risk, of course. There's no working capital requirements. It's a job. And granted, that's great for some people. It's not great for other people. But the point is that you will be attracted to something like a job if you don't sort of like grit your teeth and bear through the idea that you're going to have to pay down this loan to be able to get into this world. And once you're in that world, you kind of stay there. You jump from one business to the next or whatever it may be a lot of times. And so this is my problem whenever people like brag about, oh, you could buy a business with no money down, or hey, let's buy real estate with no money down. When you do that, every real estate investment looks like garbage because it's all cash flow negative because you don't have any money into it. And so after you're trying to deal with the paying of the loans and you're getting your rent, well, it's probably not cash flow positive. Same thing a lot of times for businesses. It looks so nasty to have a 0% down payment on a business that it's going to look unappealing. They're all going to look unappealing. And that's just part of it, is getting through that loan process. Now, the other way that you can try to get around the loans is finding businesses at lower multiples. So there are certain businesses that do sell at lower multiples, and they kind of act like a job. They are things like bread routes. They are pool routes. Now, these might be very good jobs. They may be very lucrative jobs, but they're kind of jobs. And so they sell at a lower multiple versus a storage unit that might sell at 10 times the net income because it is not a job. Like, those things can actually be somewhat passive. And so all of these multiples are basically gauging how much owner involvement a lot of times is needed, how much upside. And granted, there's a lot of other things that go into a valuation multiple besides how much time it takes for you to manage it. But that's one of the things. And that's why we do see lower multiples on businesses that kind of resemble being very hands-on, being like a job. Now, granted, that might be the way in. You can get in and then sell that business and then sort of level up eventually to other higher multiple businesses. But if you're not going to do that, and you want to just bite the bullet and do it, that will be the thing to do, is to simply pay that loan down, grit your teeth, and kind of bear through it. Some people can do that and some people can't, and you really have to assess whether that's right for you or not. But the other thing that you can do is try to find a business that is so large that the net income after your loan payments actually still makes sense to you. Now, a lot of times when people start to go down this path, they realize getting a business at that sort of level is like so much risk and so much debt that they either can't get approved for the loan or they don't want to, because again, the risk is so high. Your due diligence has to be perfect, and there is no such thing as a perfect due diligence and evaluation process, and people will kind of get gun shy and they will stay away from it and avoid it anyway. But the point is, everybody goes through the initial pain points of buying their first business a lot of times, and you have to sort of assess whether it's the right thing for you to do or not, because otherwise jobs are going to seem like they're the best business in the world in terms of how much money you're making, how much profit, how much working capital is needed. So you have to sort of figure that out for yourself. Right now the rates are pretty high, but remember that rule of thumb. If you're at a 3x multiple, you're probably going to get about half of the net income. Anyway, hopefully this helps out a bunch. Drop a comment, like, subscribe, and we'll talk to you soon. Bye-bye.